Hello! Today we're going to be completing the journal entries related to warranty transactions. A warranty is created when a company promises to repair or replace a product they sold if necessary within a specified period of time. Warranties create a special problem for accounting because an item sold in one period might get repaired or replaced in an entirely different period, possibly even years down the road. Why is this a problem, you might ask? Well, you might remember the matching principle, which states that expenses should be reported in the same period as the revenues that they help generate. This means if we were to record warranty expense in the period when the item was repaired or replaced, the warranty expense would be reported in a different period than the sale that it helped generate, violating the matching principle. For this reason, companies estimate their warranty expense in the period of the sale and report a special new liability account called estimated warranty liability, as we will see in this example in a moment. The problem says, on October 15, 2020, Ellison Enterprises sold a laptop computer costing $1,000 to a customer for $1,500 cash, which included a 5-year parts warranty. On August 3, 2021, the laptop is brought in for repair that is covered by the warranty. $30 of materials are taken from their repair parts inventory to cover the warranty repair cost. Assume that Ellison Enterprises estimates warranty cost to be 3% of sales, and an adjusting entry is made at the end of each year for warranty expense. Now the first journal entry we have to record is for the sale of the laptop on October 15, 2020. Now this journal entry does not depend on the warranty. So this is the same journal entry you would record for any sale of merchandise. So you might remember, when we sell merchandise, there's two journal entries, one for the sale and one for the depletion of inventory. So let's first focus on the sale. If we look up here, we see that the customer bought the laptop for $1,500 cash. So that's $1,500 of cash that the company is gaining. So we can debit our cash account for $1,500 to increase our cash. This was also a sale for the company, so we can credit the revenue account of sales to increase that, also for $1,500. Next, we can do the journal entry for the cost of goods sold and the depletion of inventory. So looking here, we see that the computer cost the company $1,000. So that's an expense to the company, which we classify as cost of goods sold, which increases with a debit of $1,000. And of course, the company is getting rid of their inventory, selling that laptop, so there has to be a decrease in our merchandise inventory. And we do that by crediting that account for $1,000 as well. Next, we need to record the adjusting entry on December 31st, 2020 to recognize the warranty expense related to this laptop. Now, whenever you record this adjusting entry, you're going to use the same two accounts. First, we have warranty expense, which will be increased with a debit, and then we have the estimated warranty liability, which will be increased with a credit. Now, this estimated warranty liability account is a liability account that represents how much the company expects to pay out in warranty-related costs such as parts, labor, or product replacement. Now, the way we find the value for this journal entry is we need to look at the estimate for warranty costs, which they tell us to be 3% of sales. So what we can do is we can take our sale amount, which was $1,500, and multiply that by 3%, which is 0.03. And that tells us that our warranty expense is $45, and we'll also use the same amount for the estimated warranty liability. So you might be wondering, why are we recording this warranty expense of $45 in 2020? Why shouldn't we record that in 2021 when the actual repair costs are made? And the reason, as I touched upon earlier in the video, is the matching principle. So this expense is related to the sales that were made in 2020. So therefore, the warranty expense should be reported in the same period as the sales. And that's what we're doing here. 2020 is when the sales were, and 2020 is also when the expense is recorded. Now, of course, this $45 was based on an estimate of 3% of sales. So if the company was to realize that the estimate is a little bit off and not matching the actual warranty expense that well, they can change that expense appropriately in future periods. So our last journal entry is for the repair costs made on August 3rd, 2021. So what we're going to do here is we're going to decrease the estimated warranty liability for the amount of the repair costs, because now we're paying out that liability. So we will debit our estimated warranty liability, and that will be for the amount of the repair costs. And if we look up here, that was for $30. Now the other account that we typically use with this one is repair parts inventory, which is just an asset account that represents our repair parts, and that's going to be decreased with a credit, and we can also use the $30 there. Alright, we are done with the journal entries. The last thing I want to do is to show the balance of the estimated warranty liability account. So we can post the $45 credit from there, and then also the $30 debit. And then we can find the balance by taking the credit and subtracting the debit to get $15 on the credit side. So that means we had a slight overestimate in our estimated warranty liability, since the warranty has been claimed but the account is still showing a small balance. Now, the company will likely monitor this account across many periods to see if the amount gets too large, and if it does, they might change the percentage from 3% to, say, maybe 2.5% or maybe 2%.